Would you like to own a slice of a super high quality business? Looking for a market beating yield and double-digit dividend growth? Like the idea of getting a good deal on a Dividend Aristocrat? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing critical industrial gases to companies all over the world. Most of the stuff we use every day and kind of take for granted has to be manufactured. This stuff doesn't just fall out of the sky. And when talking about the manufacturing process, which is complex, industrial gases are often critical to that process. This company is one of the very few on the planet that provides those necessary gases. Necessary? Limited? That sounds like money. It also sounds like dividends. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Air Products and Chemicals Inc., which appear to be trading at a significant discount today. Air Products and Chemicals Inc., stock ticker APD, is a major global producer and supplier of industrial gases. They're the largest supplier of hydrogen and helium in the world. Founded in 1940, Air Products and Chemicals is now a $64 billion by market cap industrial gases giant that employs more than 19,000 people. The company's fiscal year 2020 sales were reported through 4 industrial gases business segments organized by geography. Americas 41%, Asia 31%, EMEA 22%, and Global 4%. Corporate and other accounted for the remaining 2%. Industrial gases are often critical input for the manufacturing process. This applies to a large range of end products. Because of the critical nature, manufacturers set up a long-term contract with a reliable gas provider. These long-term contracts are often combined with complex on-site infrastructure to provide a constant source of gases. This makes it difficult to switch providers later. In addition, Air Products and Chemicals operates as part of a global oligopoly. Most of the global market share is basically shared by 3 major companies that have the necessary scale to operate and compete. Layering this oligopoly on top of the low-cost but critical nature of their products is a very powerful 1-2 punch, which puts Air Products and Chemicals in an excellent position to prosper. That should mean higher profits and higher dividends for many years to come. As things stand, this is a Dividend Aristocrat with 39 consecutive years of dividend increases. The 10-year dividend growth rate is 10.3%. That double-digit dividend growth comes on top of the stock's market-beating yield of 2.1%. And with the payout ratio at 66.4% based on midpoint adjusted earnings per share guidance for this fiscal year, the dividend remains easily covered. Looking at business growth, revenue actually decreased slightly from $10.082 billion in fiscal year 2011 to $8.856 billion in fiscal year 2020. Any business shrinkage, especially over a longer period of time, would initially seem disappointing. However, this reduction in revenue can largely be attributed to the fact that the company purposely decided to make the business smaller and more focused. They put together their 5-point plan, which focused them on industrial gases by jettisoning non-core businesses. The execution of this plan led to spinning off the Electronics Material Division in 2016, as well as selling the Performance Materials Division in 2017 for $3.8 billion in cash. Meanwhile, the company increased earnings per share from $5.63 to $8.49 over this time period, which is a compound annual growth rate of 4.67%. Material margin expansion relating back to the aforementioned focusing definitely helped to propel bottom line growth in the face of revenue shrinkage. It's also worth noting that the company's GAAP earnings per share can be kind of lumpy. Their growth can look mediocre or truly outstanding depending on what time frame you're looking at. The compound annual growth rate in GAAP earnings per share seemingly belies their earnings power. In my view, adjusted earnings per share gives a more accurate view into their overall growth profile, and their guidance for this fiscal year calls for 7% to 9% growth in adjusted earnings per share for the full year. Looking forward, CFRA forecasts that Air Products and Chemicals will compound its earnings per share at an annual rate of 10% over the next 3 years. This anticipated growth acceleration might look aggressive when compared to the sub 5% earnings per share growth rate that business has produced over the last decade. On the other hand, it's not far off from the top end of the company's own recent guidance for adjusted earnings per share growth. There's one piece of supporting evidence here that I think is particularly salient. Per CFRA, and I quote, APD is well positioned to capitalize on gasification related to carbon capture and hydrogen mobility, which are long-term secular tailwinds, unquote. Air Products and Chemicals already benefits from the powerful 1-2 punch I highlighted earlier. Adding on carbon capture and hydrogen mobility only serves to supercharge their potential, which gives weight to a growth acceleration thesis. That said, even if the company comes in shy of CFRA's near-term earnings per share growth forecast, they'd still be easily able to put together high single-digit dividend raises for the foreseeable future. And that adds up to a pretty picture when you're starting out with a 2.1% yield. Moving over to the balance sheet, the company has a spectacular financial position. The long-term debt-to-equity ratio is 0.62. Their interest coverage ratio is over 23. Moreover, they have a healthy amount of cash on the balance sheet. Seeing as how this is a capital-intensive business model, the balance sheet is extremely impressive. Their profitability is quite robust. Over the last 5 years, the firm has averaged annual net margin of 20.08% and annual return on equity of 18.48%. Fundamentally speaking, this is a high-quality business across the board. And they also benefit from durable competitive advantages that include global scale, barriers to entry, high switching costs, a global oligopoly, and long-term contracts with fixed infrastructure. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. There is limited competition in this industry. The competition that is present, however, is fierce. Demand for industrial gases is cyclical. Any reduction in economic output affects demand for the company's products. The company is heavily exposed to major energy projects around the world. Substantial changes in the global energy complex could diminish the company's long-term growth story. Overall, I view this as a high-quality dividend growth stock that should make for an excellent long-term investment. After a recent correction from its 52-week high of $327.89 a share, the current valuation only serves to make me more enthusiastic. The stock is trading hands for a price-earnings ratio of 34.2. That's arguably high, but it's also based off of trailing 12 months GAAP earnings per share, which can be problematic in this case. The midpoint for this fiscal year's adjusted earnings per share, which is $9.03, puts the forward price-earnings ratio at 32.2, and that's not unreasonable for a dividend aristocrat that's expected to accelerate bottom-line growth into a double-digit rate for the foreseeable future. The price-to-cash flow ratio of 17.9 isn't totally disconnected from the 5-year average of 17.1, despite the growth acceleration anticipation. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the very high end of what I typically allow for, but I think this is a business that warrants the benefit of the doubt. Their long-term demonstrated dividend growth rate is well above this level. Furthermore, their most recent dividend increase, which was announced in January of this year, came in at 11.9% during a pandemic. With the expectation for bottom-line growth acceleration being supported by a larger than average dividend raise this year, I think 8% is a rational number for the model. The dividend discount model analysis gives me a fair value of $324. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates APD as a 3-star stock with a fair value estimate of $323. CFRA rates APD as a 5-star strong buy with a 12-month target price of $341. I came in almost on the nose with Morningstar, but the overall consensus this time around is tight. Averaging the three numbers out gives us a final valuation of $329.33, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. Air Products and Chemicals Inc. is a high-quality company that benefits from the powerful 1-2 punch of providing low-cost but critical manufacturing input material within the framework of a global oligopoly. Carbon capture and hydrogen mobility only adds to the appeal. With a market-beating yield, double-digit dividend growth, 39 consecutive years of dividend raises, and the potential that shares are 13% undervalued, this Dividend Aristocrat should be on every dividend growth investor's radar. And now for a special news announcement. Allstate Corp, stock ticker ALL, just announced blowout Q2 results. Revenue is up 12.9% year over year. Earnings per share grew 36.3% year over year. We highlighted Allstate's quality and potential undervaluation in a video back in early May. This stock remains, in my opinion, a great long-term opportunity in this market. With this kind of growth, which exceeded my expectations, the deal might not last much longer. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.